Hello everyone, recently I came across a stock called Haw Par Corporation and would like to share some thoughts. Listed on the Singapore Exchange under the ticker H02, Haw Par is best known for its iconic Tiger Balm and Quan Long brand. Haw Par Corporation Ltd operates through four key business segments: investments, healthcare, leisure, and property. Starting with investments. Haw Par holds a portfolio of quoted securities. Its most notable holdings are in United Overseas Bank Limited and UOL Group Limited, which represent a significant portion of its asset base and market value. Next, healthcare is Haw Par's most recognizable segment globally. Its flagship brands, Tiger Balm and Quan Long, are synonymous with traditional wellness. The leisure segment includes operations of cultural and marine attractions. Finally, in the property segment, Haw Par manages a portfolio of commercial and industrial real estate. The most interesting segment of the company is their investments. Haw Par maintains a sizable portfolio of quoted securities, most notably its holdings in UOB and UOL Group. As of June 2025, the market value of its UOB shares alone is about 2.61 billion Singapore dollars, exceeding the company's entire market cap of $2.58 billion. This suggests that investors are essentially getting its healthcare, leisure, and property segments for free. In 2024, Haw Par's three other core operating segments, healthcare, leisure, and property, generated approximately 72 million Singapore dollars in profit from operations. When including contributions from investment income, the total profit attributable to equity holders rose to around 228 million Singapore dollars. This translates to a price-to-earnings ratio of about 11 to 12, suggesting the stock is trading at a relatively modest valuation given its strong fundamentals. Haw Par has traditionally traded at a discount to its book and asset value. This presents a value investing opportunity, especially when its investment holdings are already worth more than the company's market capitalization. It's a classic case of the parts being worth more than the whole. Looking at historical valuation metrics, Haw Par Corporation has traditionally traded at modest multiples. The price-to-book ratio has typically ranged between 0.5 and 1, reflecting a consistent market discount to its net asset value. Meanwhile, the price-to-earnings ratio has ranged from 8 to 20, indicating periods of undervaluation relative to its earnings strength. In recent years, both the book value and earnings per share have steadily increased thanks to rising investment asset values and stable operational profits. To conclude, how might an investor approach Haw Par Corporation? One strategy is to buy the stock when it trades at a price-to-book ratio of around 0.5, and consider selling when it reverts closer to 1.0. This value-based approach allows investors to capitalize on the consistent discount at which the stock trades relative to its underlying assets. Another way to look at it, buy Haw Par as a proxy for UOB. You gain exposure to a valuable banking stock through Haw Par's significant stake in UOB, while essentially getting its healthcare, leisure, and property segments for free. As for catalysts, a notable development in 2025 was the issuance of a special dividend of 1 Singapore dollar per share. This move may signal a shift in management's priorities toward enhancing shareholder value. Looking ahead, there is also the potential for share buybacks, which would further support the share price and reflect a more active capital management approach. With that, I've come to the end of my sharing on Haw Par Corporation. Thank you for listening.